with the first management onto the show. Let's put the spotlight on Patanjali Foods. The company did come out with its earnings. What's the outlook? Let's understand that with Mr. Sanjeev Asthana, who is the CEO of Patanjali Foods, joining us on the show right now. A very good morning and thank you so much for your time. And firstly, let's touch on your margin numbers. I see that your EBITDA margin did remain broadly stable at 5.74%. How do you see the margin trajectory evolving in the second half of FY26 and what factors will be at play?
So two parts. Thanks for having me on the show. One is that the margins on EBITDA front, we have done the highest ever margins. So while on percentage terms, what you did mention, it remains, but we've done more than 600 crores of EBITDA on an absolute basis. On an increased revenue that we had, we have done nearly 10,000 crores of revenue in the second quarter. And that's a very positive reflection of both the big businesses that we have. One is on the veg oil side, which is looking positive, and typically the second half of the year does pretty well. So we are hopeful that we should have a good recovery there. And second is the FMCG, where we've got consolidated numbers between foods and the HPC, where also the margins are upwards of 12%. The idea is that towards the end of the year, we're closer to between 13 and 14% of margins, because again, the uptick in the demand is pretty much there, supported both by the GST and the work the company has done. So we're pretty positive that we should end up the year on a very strong note, better than what you've seen in the first half, and certainly a lot better than what we've seen in the second quarter.
So let's see how that pans out, hoping for a better H2 for you. But hi, Mr. Asthana, this is Kanishka also joining in. Just wanted to talk segments as well. Now, edible oil segment, that has seen a growth of about 17.2% on a year-on-year basis. Tell us if this was primarily led by volumes or was it price-driven as well? And also tell us how has demand been impacted given the raw material price volatility that we saw in the quarter gone by?
So there are two things which typically drive. So on the volume front, clearly we had the benefit of the festive demand. So there we got the benefit on the overall growth is about 50% of the growth that you're seeing is on the volume growth. Because the first quarter was pretty weak. So we had a substantive benefits over the first quarter. And part of that was also driven by the price increase that we saw in the edible oil segment, especially driven by the international prices. So it is pretty good numbers in that sense, because our target volume growth is between 3 and 4%, which is India's growth itself. And the work that the company does is always, we've maintained, is the quality of profits and the predictability of margin is what the big focus on. And the second half, my sense is that we should be doing a lot better now, because the the tailwinds that I see on the international front on the veg oil prices is positive, and things seem to be looking much better, both in terms of multiple different initiatives that we've taken. So we should be on a much better wicket in the second half.
All right, but what will aid to that specifically within your FMCG now contributing a growing share to the top line? How is the product mix influencing the overall profitability and the working capital efficiency? How are you managing that?
Clearly on the FMCG front, there's a benefit of the consolidation that we have. So the HPC business, which tends to give margin upwards of 22% plus this quarter we had, though our regular run rate will be 18 to 20% on the HPC side, which is about almost nearly 3,000 crores of business, and we're expecting to grow it by 15% year on year. And on the food business, which is 8 to 10% margin expectation that we have. So there are challenges there, which continues to sort of, have an impact. But most of it is behind us now. So the GST, which almost comprises now nearly 55% of the overall portfolio at 5% GST rates. And if I were to look at the FMCG segment, it's nearly 85%, which is at 5% rate. So we saw a huge uptick in demand in October, driven both by festival season as well as the GST impact that we saw. So I'm expecting that both on the margin profile of the foods business will continue to improve. We should head closer to 10% plus. And on the HPC businesses, if we continue to push it towards closer to 20% plus, maybe 200 basis points. So we should be pretty much ending the year with close to between 13 and 14% on a blended basis, which is something that what the target the company had set itself for. And next year, of course, should be a lot more positive as we move forward with the new plans and the fully consolidated HPC portfolio in our business.
Mr. Asthana, that's about the consumption profile, but also wanted to talk about this very interesting segment that you have, the wind turbine power generation segment. That saw a slight bit of a decline, 7% revenue decline is what we have seen in the quarter gone by. So what's the outlook for this vertical, and how strategic do you think it is for the company's overall portfolio?
So it's an annuity business, that wind turbines typically contribute about 45 crores a year to the margin of the company. It typically, is about 18 to 20% margin that we have. And so there are certain windows, if there's a lag in the, raising of the bills and payment, from the government, which we have given to the government utilities, if it is there, or, the wind force has not happened. So we're pretty confident that we should end up the year with about 45 crores in that. So it is strategic at two levels. One is that, large part of our, the power consumption that we have at our units, almost nearly 60% plus is what we consume in-house, which otherwise we would have paid at a substantially higher to the government utilities to use the power. And the second 40% is what we give it to the grid. So that occasionally may have a lag in the income, which may, get delayed by a quarter or 2 quarters. But otherwise, we are quite confident that, 45 crores of EBITDA is a pretty much a run rate that windmills are going to do. And we like the business. It's, it sort of burnishes our green credentials. It's hugely profitable for the company. It's like an annuity business. So it requires a lot more maintenance. So we're working on that quite actively to keep it most efficient in the way it operates.
All right. Thank you so much for that clarity. But with this, Mr. Asthana, we'll let you go. Thank you so much for taking the time out and speaking with us on the earnings and the outlook.
Thank you.
All right. But with this, viewers, it's time now to slip into a very short break. Don't go anywhere. Lots more to talk about on the other side.